The broadcast is now starting. All attendees are in listen-only mode.
Welcome to the webinar. You have entered as
بسم الله الرحمن الرحيم. الحمد لله رب العالمين والصلاة والسلام على أشرف الأنبياء والمرسلين سيدنا محمد وعلى آله وصحبه أجمعين. Dear brothers and sisters, Assalamu alaikum wa rahmatullahi wa barakatuh. The Islamic Research and Training Institute is pleased today to have Dr. Dawood Ashraf to present his research paper. The title of the presentation is Specific Stability Risks in Islamic Bank. Before we start, let me introduce Dr. Dawood Ashraf briefly. He is currently acting manager and senior researcher in the research division IRTI. Before that, he was assistant professor of finance and investment at Prince Mohammed bin Fahd University in Saudi Arabia. Dr. Dawood holds a PhD in banking and finance from University of Wales in the UK and Master of Economics in International Business and Economy from Kyushu University, Japan. Dr. Dawood's research papers have been published in international journals, and he has presented his research works in various international conferences. Dr. Dawood will present for about 30 minutes. Then after that, we will have question and answers session. Now I would like to invite Dr. Dawood to deliver his presentation.
Thank you very much, Brother Abdullah, for your kind introduction. Thank you very much, everybody, for being here to listen to this presentation today. Basically, the idea for this presentation is to understand what are the factors that could affect the stability of the Islamic banking sector. Before going into discussion, I believe that we need to have a little bit background of the sector development and see how the Islamic banks are similar or different from the conventional banks. So if I see here the slide that you can see on your screens, that it tells you that among different sectors in Islamic finance, Islamic banking is the major sector. So about 80% of the Islamic finance activities are basically concentrated in Islamic banking sector. So for the development of overall Islamic finance, the Islamic banks are important, as we can see from this slide. So before we talk anything further, I think it's important to understand that what is the business model for Islamic banks, and why we need to have a bank with the name Islamic. So when we talk about an Islamic bank, the business model is different from that of a conventional bank. In the asset liability structure, in case of a conventional bank, either you are on the liability side or you're on the asset side, it's debt. While in case of Islamic bank, we see multiple structures. Some could be branded as equity, the others could be branded as debt, pure debt, and maybe some others are a kind of a hybrid of the two. So what we need to understand here is that the structures that we have in Islamic finance are not on a single debt structure. It's basically several different kind of contracts on the basis of which different products are structured. And the motivation for this whole research is basically is a paper in IMF 2011. It says that the business models on which a bank base their operations has serious consequences for the stability of the banks. And especially prior to 2008, the net stable funding ratio of investment banks declined more sharply as compared with commercial banks. So what we need to do is we need to understand that whether Islamic banks having a different business model, are they different really in terms of their stability risk or whatnot? So that's what we're going to do. We will discuss in more details as we go along. In terms of Islamic bankings, the Beck et al. 2013 study basically says that Islamic banks are generally better capitalized as compared with conventional banks. So my question to myself when we started this research, whether the equity-based and risk-sharing nature of Islamic contracts help reduce the maturity mismatch and the asset and liabilities and enhance the financial stability. So before putting further to this one, we need to understand what happened in the crisis time back in 2007, 2008. So the major issues that the conventional banks faced at that time, bank in general are the dealer of long-term liability and short-term liability and long-term assets. So what they do basically, they take deposits very short-term and then they issue loans long-terms. So having a structure in which you have to pay right away, while you will receive the payment after a very long time, basically create a scenario in which you might have good assets, but you may not be able to turn them into cash, and that at the end of the day may cause the bankruptcy and all those kind of things. So that's where we try to see here. So when we talk about the Islamic bank, we say that the Islamic bank is basically an equity-based risk-sharing model they operate on. But do they really operate on this risk-sharing model or whatnot? And what I did, I look at the offering of the products that the Islamic banks have, and what I see that in general, the Islamic banks have products that are more kind of debt products. So Muraba is more prevalent than any other product that we have for the Islamic banks. And then when I group them together, what I see that the risk-sharing instruments, we call them, are basically hardly 5 to 10% of the overall assets of the Islamic banks. So do they really do the risk sharing? That is something that we need to ask ourselves. And then when we talk about the Islamic bank, the other thing we claim a lot is whether the Islamic bank they invest in the real sector investments. And when we talk about the real sector investments, so again we have to look at the sectors they're investing in, and the empirical data what tells us that mostly Islamic bank, if they have an asset, it is based on commodity, and that basically we can link back to the Tawarruk and the Murabaha transaction that we have. So basically the real sector involvement that Islamic bank have mostly is linked with the Tawarruk or Murabaha, and that's why we see bigger investment in the case of commodities that the Islamic banking is having. So risk factor that we need to see specific to Islamic banks. So first thing is the model that we envisage as the risk sharing model. Is it a risk mitigating model? So this is the major question. So when we talk about risk sharing, we somehow assume at one point that means there is no risk at all, or the risk is basically spread out. But does that mean that the spreading out of the risk is basically a risk mitigating factor? So are the Islamic banks are less riskier as compared with the conventional banks? So what we need to see, basically, we need to look into the assets and liabilities of the Islamic bank. So if I look at the liability side of the Islamic bank, so predominantly we see that in terms of liability, the deposits they are taking are profit sharing investment accounts, whether they are restricted or unrestricted, but they are mostly savings accounts. So the nature of these deposits theoretically is kind of a hybrid equity, but practically it is a deposit. So the banks, Islamic banks, even still they give a guarantee to the depositors that if anything goes wrong with the bank, they will be able to return back your deposits to you. So that means these are, although theoretically are equity kind of contract, but practically these are similar to as deposits. While in case of assets, predominantly the Islamic banks have a kind of fixed rate Murabaha contract, as I have shown you in the previous slide. So that means mostly the contract that on the asset side, the assets that Islamic bank have are basically based on fixed rate contracts. So when I'm looking at the asset side risk for the Islamic bank, and the assets are the core, as I mentioned to you, that the maturity mismatch occurs because the liabilities are short term and the assets are the long term. So having that, the first thing that arises is the profit rate risk for an Islamic bank. So profit rate risk basically is that if you have more projects that are risky and the investor are neutral in terms of accepting whether there is Islamic and un-Islamic offering in the market. So if you have more higher profit rate available to investors from a conventional bank, so most probably the conventional bank who is not following the faith might move towards the conventional bank. So this basically raised the issue whether the Islamic banks, can they stay in the market by offering whatever their returns are, or do they have to compromise on something and make sure that the deposit they are receiving stays within the bank? So this is the risk that the Islamic banks are facing. So meaning that the Islamic bank sometimes, under the pressure of the market, has to pay a profit which they actually have not earned just to stay competitive in the market. Then the second risk that Islamic bank usually assume, and I showed you the previous slide in which I showed the specific sector. So Islamic banks are facing the specific sector risk. So if I give you an example, the Islamic banks are investing mostly in commodities, and in commodities you face the risk of commodity price fluctuation. So if you're holding commodities in your portfolio, so basically you face the risk of price fluctuation. And then the real estate risk, we know that what happened in 2008-2009 crisis, when too many banks are involved, mostly the liquidity is available in the market, the real estate become a financial asset. So it does not reflect anymore as a real sector investment. It is basically a financial investment. So the demand and the price of the real estate can change dramatically with the change in demand and supply of the real estate, not only the real estate, but also the availability of the money in the liquidity in the market. So in what happened in the conventional banks side sector, so to enhance the stability of the banks, so we see one after another the capital regulation accord. So Basel I came because of the saving and loan crisis, and in which the basic capital adequacy requirement was introduced, and then Basel I came in 1998, and then Basel II came, which is basically an update of the Basel I, in which more sophisticated method for calculation of risk is included. We talk more about the three pillars: the credit risk and the market and the operation risk. But the moment the Basel II introduced, we faced the financial crisis of 2007-2009. Then the regulator has to go back and think how we can reduce the stability risk of the banking sector. So what happened in 2007-2009 financial crisis, basically the banks were not able to meet the liquidity requirement, and we know that at that point of time a lot of the central banks has to jump in. They have to put more cash into the banking sector, they have to increase the deposit insurance limit, and so on and so forth. So to avoid that crisis happening again, the regulator think of that we should ask the banks to maintain more of the liquid assets. So they introduced the ratio of the liquidity coverage ratio, but the most important was the net stable funding ratio. So this net stable funding ratio basically requires the banks to naturally hedge the maturity mismatch. That means they cannot have the very long-term assets financed with overnight borrowing from the capital markets. So if you want to have long-term assets, you should have to have long-term liabilities to support to have those assets. So I already have mentioned that what led to the Basel III, basically too much leverage and insufficient high quality capital to absorb the losses, excessive credit growth and underpinning of the credit, underpricing of the risk, high degree of systemic risk. We had at that time inadequate capital buffers to maintain lending in times of stress, and insufficient liquidity buffers. So this was the conventional side. So Islamic banks, do they face the same challenge? We have a lot of studies that talks that Islamic banks were resilient during that time, but my personal view is the Islamic bank was not big enough at that point in time that we could say that the financial crisis whether affected them or not. But can we think the same way now we are in 2016? Unfortunately not. Like the figure that you see on the right hand side, that basically tells you the share of Islamic banking assets in the overall banking sector, and you see that there are at least 10 to 15 banks, 10 to 15 countries where the Islamic banking sector about 15 countries where the Islamic banking sector is more than 10% of the total banking assets. So can a regulator simply ignore Islamic banks thinking that it's a small banking sector and we should ignore it? Not at all. Now they have to think about it, how we can make sure that the Islamic bank do not cause a stress in the overall economic system. So, but do we consider Islamic bank same as the conventional bank? And as I mentioned to you, the deposit, their balance sheet structure is different from that of the conventional bank. So being different, having a different balance sheet structure, they need to have a different way to address their issues, their concerns. So we believe that there is a need for a separate regulatory framework, and fortunately IFSB has done that part. They have introduced a regulation called IFSB 15, and NSFR is a part of that that regulation that basically requires Islamic banks to be at the forefront of maintaining stability and enhancing their maturity and reducing the maturity mismatch. So that's how we look at this issue of the stability. So on one side we have the conventional bank, on which most of the assets that they have are based on a debt contract. Then we have the Islamic banks. Most of their engagement with their customer, whether it be on the asset side, on the liability side, is on based on different contracts. So say for example, current accounts that we have on conventional banking side, it's debt for sure for them. For Islamic bank, it's a debt. Qard or Wadiya is a debt, both sides. The profit sharing investment account we treat as equity. We have PSIA restricted, purely equity. PSIA unrestricted could be a hybrid. Sukuk can be a debt, however can take another form as well. Murabaha in loan and advances could be a debt, is a debt. Musharaka is an equity transaction. Ijara is a hybrid with fixed payment, but liability can change over time. Qard al-Hasana is a debt. So what I'm trying to tell you here is difference between the type of contracts, and based on the type of contracts, the way we calculate the net stable funding ratio should be different as well. And if you see that the last two columns basically tells you how the net stable funding ratio, the weights of each element in net stable funding ratio, as compared the comparison between the IFSB regulation and the Basel III. So, and the major difference that you see that in case of Sukuk, the Basel III does not address that, but we treat them 100% debt and we charge 100% capital for that one. So similarly, we go down and Qard al-Hasan, there is no haircut for Islamic bank, but for the conventional bank it is 85% haircut. So there are differences between the two, and that's why we need to understand whether the impact of the IFSB regulation is any different from that of the Basel III one. So how we did it? So we look at the sample that we have taken in this study. It's an empirical study. So the sample that we have used, we have taken it, the in-house database that we have. It's called Islamic Bank and Financial Institution, or IBIS database. So we use all the data from this database, and the reason why we use IBIS database, because there is a difference in variable definition under Islamic and conventional banks for the calculation of NSFR for Islamic banks. So we need data on Islamic products based on the underlying Islamic financial contracts. So the use of IBIS data makes sure that the contract that we are using, the weights or the haircuts that we are using is actually the haircut for the same type of contract as in the IFSB regulation. So the sample that we had basically consists of 133 Islamic banks from 30 different countries, and we took some macroeconomic data from the World Bank website. So I'm not going to go with all the the modeling and all those things. I'll just straightforward go to the empirical findings, and what we see that for the period that we have analyzed, if NSFR ratio has been implemented as a regulatory requirement for Islamic banks, it would have a positive effect on Islamic banking stability. What we see that the smaller Islamic banks are more stable than as compared with the larger Islamic banks. We see that the banks with more diverse income sources are more stable. We also see that banks with higher cost-income ratio are less stable. That means they are spending more money and they're earning less. So being less profitable bank will make them less stable. We see that the global financial crisis has no effect on the stability of Islamic banks. We also see that the market competition hurts financial stability of Islamic banks. So what Islamic banks might need to do is they need to, the competition is good in the market, but they have to find more sources of income as well for that. And we do not see any effect of constitutional religiosity on the stability of Islamic banks. And the reason for having the constitutional religiosity in our empirical estimation was basically, we thought maybe the countries that have more religious constitution, there might be more, the acceptance of Islamic banking would be higher there, and with higher acceptance of Islamic banking might be this constitutional religiosity might cause the banking sector to be more stable, but we did not find any evidence to that. And unfortunately, the last finding is the banks under fully Islamic banking systems are less stable. And when we looked at that, the two countries that have the full Islamic banking are Iran and Sudan. And both of these countries were politically unstable during the sample period that we have. So having international sanctions, thank you very much. Having international sanctions on both countries during the sample period would have affected the stability, and we see that both of the countries have faced very high inflation. All those high inflation definitely affected the stability of the banking sector. So this last finding, we are showing it, but we are showing it with a reservation that the two countries that were having fully Islamic banking sector was not stable, but the stability, the instability impact may not stem from the banking sector itself, but rather it might have come from the political instability of the two countries. So in short, in general, we say that due to structural changes, there is a need for separate Islamic banking regulation. We agree with that. IFSB's adjusted NSFR measure served the purpose. It enhanced the stability of the Islamic banks. Islamic banks, on average, are sufficiently funded during our sample time period. The ratio of the net stable funding has the capability to increase financial stability of Islamic banks. And our finding basically validates the IFSB's adjusted NSFR for Islamic banks. And we strongly recommend regulators to implement IFSB adjusted NSFR for Islamic banks rather than conventional NSFR under Basel III. Thank you very much.
Thank you, Dr. Dawood, for your informative presentation. Now we open the floor for any question or comments.
Yes, brother.
Do you have tables or any equation that you can show us? I can see anything, so I can understand.
No, that's definitely. I intentionally not put any equation here, but definitely I can share with you this paper, and there we can further discuss that. But the paper is available. The paper got published in the Journal of Financial Stability back in 2016. So I can definitely share that with you. But if you really want to see some tables or anything, I can definitely.
Right now,
Absolutely. I agree with you. The reason why I put it this way basically is to make it more convenient for those people who trying to understand the impact. So not purely for the academic community, but definitely I can share with you. Let me just put it out. I can share with you privately as well, and then let me just take this out paper. But we can have another question in the meantime.
Dr. Khan?
My question was his question.
Okay.
What was the definition of the worst stability?
Oh, good God. Oh, good. Let me.
The black box.
Okay.
Okay.
So,
تفضل أستاذ.
I'm assuming this is more stringent.
ممكن
I'm sorry. Sorry. Yes. Yeah.
مو شغال. It's not working. Maybe you can use the other one.
Hello.
Yes.
So, just regarding the recommendation on the net stable funding ratio for some banks. I'm assuming this is more stringent than it otherwise would have been. That's the point, I think. But also, to what extent does this put, I mean, would this put Islamic banks at a disadvantage versus conventional banks, given that this recommendation was to be adopted, they would have more stringent rules to adhere by?
Okay, so the thing is, what we need to understand in case of the Islamic banks especially for the IFSB and SFR and the Basel III, the major difference are the haircuts. So these haircuts are based on the nature of the transaction that is underlying each contract. So what we see here, like I'm trying to show you here, that so say for example, in case of profit sharing investment accounts, if you are under Basel 3, so you have to put 95. You have to apply basically 95% of that as your on your liability side. So you have to take off basically only you can take off 5% of that. So 95% has to be as part of your liability. So that will increase your requirement for that one. So, but in this, for the case of Islamic banks, if they have restricted PSI, so they don't have to put any haircut to that. So that means they don't have they don't have to put any capital to support for that part of the liability for the so that basically become part of equity for the Islamic bank. So similar to that, we can talk about, say for example, in case of Qard al-Hasan, the haircut required is 85%. But for the Islamic bank, it is only it's got to 0%. So that means Islamic bank when it gives loan as a Qard al-Hasan, they don't have to basically put any capital to support that Qard al-Hasan. And similarly, when I look at the Ijara transaction, for the Ijara transaction, the haircut under the Basel III is from 50 to 65% depending on the nature of the lease, whether it's operating lease or the capital lease. But for the Islamic case of Islamic finance, it's flat 50%. So that means if they apply on some side, they have to pay more charge to it, but on the other side, based on the contract, they pay less charge to it. So basically, it is in the advantage of Islamic banks to follow or the regulators to follow for Islamic banks to be more compliant with the way their business model is. So the most important part is, since the business model of Islamic bank is different from that of a conventional bank, so you cannot make it subject to the same regulation as that of the conventional bank. So that was the main idea behind the paper and findings. Okay, so I'll go back to the questions that we had previously, and unfortunately I did not put any one of these in my slides. So let's go to the tables, and if you can see, where is my cursor? Okay, so now I can move it a bit. So if you see here, there's a lot of explanation of the Islamic product, the conventional counterpart, what is the nature, what are the weights and all those things. And then again, the same picture that I was showing you earlier. And the calculation of NSFR, how we did that. That's the basic equation. I don't know whether you can see it or not. So that's unfortunate that I should have taken some of these. So I request everyone, like whoever needs the paper, I can share the paper with you.
The best thing to share.
To share. Okay, okay, I will do that. I was just trying to like the main finding table, if it could help. Anyways, I'm sorry. I'm sorry for that. I should have brought those tables before. So
We'll take the next.
Yeah. Okay, we can take the next question.
Any comment?
Yes, please.
Yes.
One of
point which you said you verified it was small Islamic banks are more stable, which is I think from IMF paper. I mean, do you have any reservation on that?
Not really, not really. See, the thing is,
They had the reservation on what they found.
no, see, the thing is, what we have found basically a negative relationship between the stability and the, and now we can talk with terms of the table that we have saw. So what we have found in general, that the size is inversely related to the stability of the banks. And what we can say based on that, that the smaller banks are more stable, and it makes sense as well. So as the bank,
Conventionally, they have mentioned it is opposite.
the Becketel paper doesn't say that.
Larger banks are more stable.
I'm not sure then. I'm not sure. My understanding with Becketel paper is the smaller banks are more stable, and the reason for their stability is that they are more focused on the activities that they are supposed to, and as they move along with more and more activities, they basically enter into those domains that they are not really specialized in. So that's why their stability would be affected as they grow bigger and bigger. But maybe I may be wrong with that. But my understanding with Becketel paper is that smaller banks are more stable as compared with the for some banks. Ah, okay. Maybe I've done. Sorry.
That's why I was asking. What is the size for them?
In general, the relationship with the size, like there was no specific million or $1 trillion size. It's in general with the sample when you rank them, and among the rank, the smaller banks showed more stability as compared with the larger banks. But there is no cutoff for the size. We do not have any threshold for that. We use the Z-score. Use the Z-score as a measure of stability.
Could you show the equation you want to know? So we can make of that.
دكتور زاهي عندك سؤال؟
تفضل.
تفضل تفضل.
Assalamu alaikum. Thank you very much, Dawood, for the insight and presentations. My question is regards because you come to the conclusion that full-fledged that is likely to be less stable comparing with small bank or maybe small bank or Islamic bank also they will be full-fledged small bank. But regard samples, I don't know whether you use pool analysis, you pull all the countries together, or
that's what we did.
Yeah, so if you make pool analysis, then you will find a sample, full-fledged sample, and not full-fledged samples, then they will likely affect. But regard Sudan, you determine profit, risk, and real estate risk. In a country like Sudan, even the Islamic banks, due to the sanctions, they are not financing the real estate. They are just working on the, financing others. But the real estate is by regulations, they are not allowed to do that. So they may likely. Other things, moral risk in Islamic countries that where Islamic banking, whether full-fledged or risk, moral risk is very high even than the other risk. So that is also may need to be put it in the considerations.
Yeah, thank you very much, Brother Zahi. Two part of your question. So one is our finding specific to those countries that have 100% Islamic banking sector, and secondly to the moral risk. So the first one, I presented my finding with reservation. And the reason for the reservation, as I mentioned to you, is although our findings suggest that the banking sector, the banks in the banking sector of those countries where there is 100% Islamic finance are less stable as compared with the countries where we have the kind of mixed financial system. My reservation was basically both the countries that have 100% Islamic financial system remained under sanction for the period in which we did this analysis. That's number one. Number two, we know that there was some political instability, the war and all those kind of things were going on with those two countries. So since their condition was not stable at that time, and that instability might trigger into the financial sector as well. So there is not at any point in time I'm trying to criticize anything. What I'm trying to tell here is that we have found this, and based on that, this is our understanding, and that's what I'm presented. Now with the moral thing, somehow it is not that easy to model within any empirical estimations. But what we did in this study, we looked into the constitutional religiosity. So there is a paper in which from Booth School, the gentleman has basically created an index that tells you whether the constitution is more religious or not. So in our case, what we have taken is we took that religiosity index, and that is basically more closer towards Sharia. So if the constitution is more religious, it might basically tells you the overall morality kind of things of the society. But again, I cannot judge based on just the constitutional religiosity, and we did not find it anyways any significant in terms of explaining the stability of the Islamic banks.
In your model, you include non-performance finance. In your model.
Non-performance finance?
Yeah. This is like in convention for non-performance loan, but it seems in Islam full-fledged no loan, then we call it non-performance finance.
I do not recall that I specifically use that or not. I do not recall that I specifically have used that or not.
That also will tell you the non-performance of the Islamic bank, and also you can make qualitative analysis to find.
Definitely. See, the thing is, I do not recall that. I might have done it, but I do not recall that at the moment, so I cannot comment specifically on that one. Yes, brother.
So, thank you very much for the result. I'd like to get your opinion, because I believe you said during the global financial crisis, there have been a lot of write-ups saying Islamic banks were more stable than the conventional banks. And you said basically you don't really agree because they hadn't reached that critical skill. Okay, now in hindsight, they've reached that critical skill. Do you think if we have a crisis today, from your opinion, that they'll actually be more stable than the conventional banks?
Thank you very much. It's a very, very sensitive question, and I try to answer it based on my understanding. So again, this is my personal view. It has nothing to do with the view of the institution I work for. So we have to be very careful with that. So now, the thing is, we have to understand how different Islamic banks are in terms of their activities. So if their activities are in line with the basic teaching of the ethical codes that has been proposed, and we all know all those. So if they are more aligned with that, I 100% believe during the crisis time, the Islamic bank would survive very easily. However, if we are moving more and more towards a model which basically mimic the conventional model, so then do not expect any different result than from the conventional bank. So if the Islamic banks are doing the same activity or at the same level, then there would be a impact on their stability. Personally, at this moment of time, I feel most of the banks in general haven't reached as single bank, haven't reached the critical mass, and not engaged in all those kind of activities that we specifically mentioned with the global financial crisis. So I hope that we would be able to survive better than the conventional banks if that crisis struck again. We are better capitalized now. We are more stable in funding, and we are more liquid as well. So hopefully the Islamic banks would better able to absorb the shock if it happens. Yes, brother.
Yes, that's a question to connect. Thank you very much for the presentation. My question is, actually, we talked about cryptocurrencies. Do you think that Islamic banks, when they go in the direction of cryptocurrency, it may help the stability of the banks? It will have like a investment pool of cryptocurrencies, and the Islamic bank is going to help the stability. How you may
Okay. Let me first admit that I am a really naive person to ask this question. And the reason is I can talk about Islamic banking, but cryptocurrency to me still is hasn't reached the level that we can take into consideration. But the thing is, what we need to understand basically with the cryptocurrency is, and very clearly, how we can link these cryptocurrencies with the real economic activities. So if we can somehow link that, which I personally feel at the moment is not there, so that needs to be addressed at both levels, at the operational level where the currencies has to link with something. Maybe we need to discuss this later in the corridor. We'll do that, inshallah. Anybody else?
I think this currency, any currency, the definition of a currency is a medium of exchange. If any country accepts any type of currency as a medium of exchange, that is good. People now money for this type of new currency. It is a medium of exchange. It's officially any country accept any currency as a medium of exchange, and it is currency.
So you are sustainability of
it has nothing, currency has, it has nothing to do with Islam. Any currency, it has nothing to do with Islam.
Okay, we have a question from online.
So you see, this is measuring Islamic is no currency here, GDP. So this is no. Currency is the middle of
Brother Zahi, I think we need to take this discussion to the corridor, to the corridor. No, thank you. I really like the way you raised the thing, but the thing is we try to stay focused on this specific research. So we have a question online, and the gentleman is trying to ask whether the Islamic banks. Can you read the question so that? Okay. So the question basically is, without the glasses. So when you say there is no effect of global financial crisis on Islamic banks, do you take into consideration the fact that maybe there was no stakes of Islamic banks in there, and the top of the financial risk had positive impact on commodity prices due to inflation and eventually benefited the real sector? Okay, so here we have two things. First, whether the Islamic Bank, and we discussed the first part, which is whether the Islamic Bank has reached the critical mass in to which the Islamic banks could have been impacted because of the financial crisis. And the second thing, he mentioned that the Islamic banking might have been benefited from the inflation in the commodity prices. So both questions are basically, the first question we have addressed, and the second question is, in fact, out of the scope of this study. But I'll try to answer this question. Yes, if the Islamic banks are holding a lot of the commodities, it might have benefited it, but that need to be studied. It is not studied as yet. So that's it. Yeah. Thank you. Yes, brother.
On this question of commodities, why are Islamic banks holding capital? Is it to do with Dawood and Rabi and sort of or they holding it for longer?
No. See, the thing is, the way we showed it is their engagement. Right. So, say for example, if they buy and sell, they basically get engaged in the commodity transaction. So that's what we say. They're not holding it. There are a few banks we know that hold they hold commodities, but most of the Islamic banks, they do not hold, but they do transact.
Precisely, this is why I can't understand why they would benefit from inflation if they're not holding.
No, those banks that are holding the commodities, then they will benefit from it. Not the one that are just transacting it. Okay. Yes, brother.
My question is because based on your presentation, it seems that your conclusion is that Islamic banks more stable because of NSFR is following the IFSB standards. But here, in the real test will be on the event of crisis because we need to see the underlying contract itself. Sometimes they just use the label ijara, but in actual fact it's not ijara.
Murabah is Murabah per se. It's all about that. So I think the real test of listing, the completion of your study is totally based on if even crisis happen, then you know whether some events must be lost from that condition.
Absolutely agree with you. Absolutely agree with you. We have done a retroactive study. So this retroactive studies, what tells us basically is the past. So what's going to happen in the future? We don't know. And as you have mentioned that if Islamic banks are doing the same thing as the conventional banks, so then we should not expect any different results. Thank you.
If Islamic banks will use different method for calculating, do you think, in other words, they will be rewarded for doing the contracts that require less capital, maybe like equity more than what brother said, but they do it really more? I mean, there will be some checks and balances in place by regulators. It will induce them, or in other words, motivate them to do things correctly, but also benefit from this new regulation. I mean, that they will.
But definitely. See, the thing is, the role of regulator is the most important for shaping the behavior of banks. So, if the regulator is treating the Islamic bank same as the conventional bank, don't expect Islamic bank to be any different from that of a conventional bank. So if you want the regulator, if you want the Islamic bank to behave like an Islamic bank, so then you have to regulate the Islamic bank as an Islamic bank, meaning the liability side, if it has equity in it, be sure that treat it as an equity. Give the bank the credit of that equity. And if on the asset side, if the bank is giving the equity financing and being the equity financing, give it a break. Like right now, if you are following Basel III, and if a bank is engaged in equity transaction, the capital charge is 400. That means for every $100, they have to put $32 of capital for that charge. But if you do the same thing with an Islamic bank, the Islamic bank would not go for an equity transaction whatsoever at all. So again, as I mentioned earlier, if you want the change the behavior. Yes.
This is a good point you mentioned, and the reason why it's a very important point because the capital charge itself, I mean, if there's a sort of level playing field, if you like, between Islamic and conventional banks, you mentioned equity, but the downside to that is that at the same time, banks are sort of taking equity positions, and the stability is thereby sort of negatively affected. So you have a sort of situation where the regulation accommodates a more Islamic banking, what Islamic banking really should be, which is more equity focused. Then the risk to financial stability, not just to the individual banks, but also systemic stability, also increases as well. So what's your process?
Okay, so again, this is very personal view on these things. I personally believe that we have very few financial assets in the market. That means if we have more equity-linked asset available in the market, the stability will enhance. Right now, the way the things are, it basically induce speculation. You have fewer assets, you have more money to chase it, it will induce inflation, and then at the end of the day, the asset does not value what exactly it is, you will see the bust. So for the Islamic banks, if you have a larger pool of equity-based assets, so some will perform good, some will perform bad. The only thing that we have to understand that the job of an Islamic bank is not only to provide equity financing, but also to evaluate and monitor. So if we take out the evaluation and monitoring part, yes, we will face all these issues. Hopefully I answered your question.
Yeah.
My question is going line with the question of whether that was sitting to my left of asking, and about the personal opinion you expressed saying that if or the closer Islamic banks go to being 100% Islamic in their own operations, the more stable they will be. So during the course of the back and forth questions, you mentioned that there's a regulatory aspect to it. If the regulators regulate them as Islamic banks, this will help them, encourage them to actually do that. Is there not also a customer side aspect to it in terms of getting the consciousness within Muslims or non-Muslims to actually bank Islamically? Same way in the halal sector, you have this thing of, well, if you eat halal and you only eat halal, then maybe the halal industry will be benefited. Similarly, is there a dawah element to actually getting the message to Muslims of how haram riba is and how beneficial Islamic banking can be, etc., etc., etc.? Is that not an aspect that is central to the success of Islamic banking, but in reality it's hardly ever spoken about, if ever?
I agree with you. I agree with you on the part that we need to educate Muslims first what Islamic banking is, and the more we can do it, the more people will move towards the Islamic banking, and most probably the self-regulation will help us to get closer to the aspiration that we have. It might take some time, but I'm hoping that it will be soon, inshallah. Yes, please.
Assalamu alaikum.
Alaikum assalam.
So thank you very much, and I apologize I joined late. I had this on my schedule today, so to come and join you when you start. Well, with my little knowledge on the subject, but of course the interest of the issue to the IDB, the issue of promoting Islamic finance remains a major mandate for IDB. And that, of course, brings an element of a conflict of interest on what we say, especially when it comes to academic research, vis-a-vis what is done globally. We need to see how we really support those theories. Now, from the partnership aspect of the IDB, we've been dealing with a number of partners worldwide where they've shown interest in Islamic finance. What we see in the future, given the fact that the portion of Islamic finance in the global economy is still really very marginal. When you look at the whole total banking business worldwide, Islamic finance really
it's very tiny part.
And that raises speculations about the stability issue vis-a-vis the 2008 crisis, because at that time Islamic finance wasn't something that was expected to be hit by the storm anyway. But my question is that we expect to see more of the mixed type of financing than specific dedicated loan Islamic finance separate from the conventional finance. The reason I'm saying that in our recent interaction with Russia, they want to introduce Islamic finance. So these are windows of Islamic finance banking services within the conventional banking. Spear banks and the central banks, and then these are huge in terms of the European banking. We've seen France now is coming forward, and they wanted to take it seriously at the parliament level. They wanted to see how they can introduce it, and want to see the legal framework of how the Islamic finance can be introduced in their existing financial system. Luxembourg is already well established, it's even constitutionalized, and UK has also some advancement in that area. What I would like to say is that did you have the chance to see those, because those are real setups that you can globally kind of promote and support, where you see how the conventional banking in UK is dealing with Islamic finance, and what are the kind of stability risks that are affecting both ways, in a kind of a comparison between those two in the same environment.
Within the same.
That would be more legitimate, because they're both working under the same conditions, the same environment. The exception, of course, is the magnitude or the portion, because of the, and that can be used as a tool to
Sure. See, since you have brought in a new dimensions to the discussion, so in terms of research, yes, in IRTI we are looking at some of these issues, more on the legal framework kind of situation. In terms of the empirical studies, these countries have not reached to a level where you can empirically test whether the Islamic banking sector is doing anything or whatnot in those countries. But I do agree that we need to look at more openly to a lot of things. I personally believe that the Islamic finance is nothing but a set of values. A set of values that basically helps to do things better. So help to reach out people better, invest their monies better, provide more stability to the financial system, get more closer to the real sector of the economy. So if anything can help that, that basically promote the cause of the Islamic finance. So it could be as mixed that you have sent. If it does that, and it basically agree to the value system that we have in Islamic finance, I think we should go and appreciate it. I specifically give you an example of the equity markets. So when we talk about the equity markets, it's generally considered as conventional, but when we look into these equity markets, say for example, if I talk about S&P 500, so from S&P 500 there are about 250 equities that are investable by a person who is following the faith of Islam. So the horizon is big. We may not be able to capturing that at the moment because of our I would say more focused things, more focused view on the Islamic finance. So again, we might have to, as you have mentioned, we might have to move a little bit further and try to embrace the newer concepts in Islamic finance. I hope I answered your question. Yes, brother.
Yes.
I think, as you said, the values or principles of Islamic thing, and in the context of regulatory looking at stability, should be universal. If conventional banks use similar contracts that are true to Islam principles, they should be treated similarly, like not by Basel maybe, but by the way you kind of explained, so that if it is like equity based, it should be like less higher tax. So it should not be by name, but true nature of transactions and contracts. So this is how it should be, and I think this way, rather than talking about Islamic, and it has parallels with halal also, brother mentioned, it's because these principles are for humanity. It's just not by name. They're true and good for all people to use it. So if we take it to that level, I think maybe more appreciation and acceptance will be get these ideas.
Yeah, they agree with you. They agree with you.
So we'll take one final question from the webinar, then we'll close it.
How big is positive impact? How big is positive impact of NSFR implementation on stability of Islamic banks?
Okay, I just have to then. Now people are asking to take me back to the table. So what basically it tells that if you 1% increase in your NSFR ratio, basically increase the stability by 0.13. So the more you will have, the higher the NSFR ratio a bank has, the more stable it will get. Okay.
We'll take the last question now.
Sorry, I followed the presentation from the webinar. But I don't know how to ask questions. That's why I come down.
Okay. Thank you very much.
Actually, mine is a general question. Actually, what happened during the 2008 and 2007 world financial crisis? The American government and other Western governments, they came in directly physically to rescue the banks. Now, I have been contemplating this in my mind. What would happen for this if Islamic banks find themselves in this kind of situation? Will countries such as Iran and Sudan that implement full Islamic banking come in and rescue the banks?
This is a what if scenario. Since it did not happen, and inshallah it will not happen. So we hope it will not happen. So I don't know. I don't know the answer, and I cannot speak on behalf of the regulator in Iran or.
The reason why I ask this question is that I have seen that generally Islamic finance, when we look at it, is just like holding itself. I mean, there is no support, strong support from the governments. And even in the West, we see that, like what happened in the United States, the government intervened to rescue the institution. I think Islamic banking and Islamic finance is not getting that support. So there is need for the governments to, support the system. If we wanted to say something.
I put it other way around. I say that it is the responsibility of the Islamic Bank to make sure that when they face a crisis, they have enough resources. And in that case, we can have a simple takaful model for deposit insurance. And that takaful model can be helpful for the Islamic banks in case of crisis. But we know that with the deposit insurance model that we have in the conventional side, it basically induces a lot of the higher risk taking and the moral hazard issues. So hopefully the Islamic banks, when they contribute to takaful and they know the limitation of takaful, it does not have the full capacity to absorb all the losses. So hopefully that will discipline them in terms of the moral hazard issues and all those agencies problem that we love to talk in finance. So thank you very much.
Finally, I would like to thank you all for your attendance and support. I hope we will see you inshallah again in our next seminars. Wassalamu alaikum wa rahmatullahi wa barakatuh.
Today was a tough day for me. Like I started first meeting at